Most people believe banks exist to help you save money. They think the system rewards discipline, good behavior, and smart financial choices. But the reality is very different. Banks don't operate on morality. They operate on behavior patterns. And one of the most important patterns in modern banking is this. People under financial pressure generate more profit. Not because they are bad with money, but because the system is designed around dependency. And here's the shocking part. At around $20,000 in liquid savings, something fundamental changes. You stop behaving like a dependent customer and start behaving like a financially independent decision maker. That shift quietly reduces the profit the system can extract from you. In this video, we'll break down the top 10 ways banks lose control when you reach $20,000 in savings. And by the end, you'll understand why this number matters more than most people realize. Banks don't charge overdraft fees completely at random. The system is built around timing, transaction order, and behavior patterns. When your account balance gets low, every transaction becomes more important than you realize. Some banks may process transactions in ways that increase the chance of multiple overdraft charges. A few small purchases can quickly turn into several separate fees. One simple mistake can sometimes trigger 3, 4, or even 5 different charges. But everything changes when you keep a healthy cash buffer in your account. With extra cash available, your account rarely gets close to zero. That means overdraft problems become less frequent and less important. And just like that, one of banking's most reliable fee-generating systems loses its power over you. Without savings, credit cards become survival tools. People swipe their cards just to cover basic expenses. With savings, credit cards become simple payment tools. And that difference is massive. Credit card interest rates often range between 20 and 29%. Interest compounds month after month. Small purchases can turn into long-term debt. With a $20,000 emergency fund, you pay your balances in full. You avoid debt, stop paying interest, and banks lose one of their most profitable Many people don't realize something very important about banks. Even basic bank accounts quietly make money from small charges, maintenance fees, service charges, and minimum balance penalties. Individually, they look small, but together they are extremely powerful. Now, when you have $20,000 saved, you qualify for better account tiers and avoid most penalties. You become what banks call a low-maintenance customer. And low-maintenance customers are always less profitable for banks. Two people can have the same credit score. But the one with savings looks less risky, feels less desperate, and has stronger negotiation power. Because lenders know something important. A person with savings can walk away. And in finance, the ability to walk away changes pricing. Car loans get cheaper. Personal loans improve. Mortgage terms become more favorable, even without income changes. Savings don't directly increase credit scores.
But they change behavior that does. Lower credit utilization, fewer late payments, less reliance on revolving credit. Over time, your credit profile becomes cleaner and your financial risk decreases. And once risk decreases, the system can't charge you premium pricing anymore.
Financial stress creates urgency. When money is tight, every problem feels like an emergency. And that pressure often forces people to make fast decisions they later regret. Without savings, you don't always have the luxury of waiting. You may feel forced to accept whatever option is available, even when it's clearly not the best deal. Many people rush major purchases because they need an immediate solution. The result is often higher prices, poor choices, and money that could have been saved. Urgency also makes convenience seem worth any price. When you're under pressure, paying extra feels easier than taking time to explore better alternatives. But with a $20,000 financial cushion, everything changes. You gain breathing room, confidence, and the ability to make decisions on your own terms. Instead of rushing, you can compare prices, negotiate better offers, and wait for opportunities that truly make sense for your financial future. Patience is one of the strongest financial advantages because when you're not desperate, you can walk away from bad deals, and urgency stops costing you money. Studies in behavioral economics show that financial stress reduces cognitive performance. When money problems dominate your mind, clear thinking becomes much more difficult. Under constant pressure, people focus on immediate problems. Long-term goals become harder to see when every day feels like a financial emergency. This often leads to short-term thinking. Decisions are made to solve today's problem, even if they create bigger problems in the future. Financial pressure also increases emotional decision-making. Fear, frustration, and anxiety can replace logic when money feels uncertain. But when financial stability arrives, your mindset begins to change. You stop reacting to every problem and start thinking further ahead. Instead of constantly surviving, you begin planning. You optimize your choices, manage risks, and build a stronger financial future. And this shift can change lifetime financial outcomes, because long-term thinking often creates opportunities that short-term thinking never sees. When you're financially stretched, every decision feels risky. Switching banks becomes difficult, and even small changes can feel overwhelming. Leaving a bad job feels dangerous because losing income could create even bigger financial problems. And when money is tight, your ability to negotiate becomes limited because you need every paycheck. But everything changes when you have $20,000 saved. That emergency fund creates breathing room. Now you can switch banks, change jobs, and survive major transitions without panicking about money. You gain something powerful called exit power, and people with exit power are much harder to control. Banks make their biggest profit from customers who stay stressed, in debt, and dependent. This is the type of customer who constantly pays fees and interest every month. But when you reach $20,000 in savings, everything starts to change. Emergency borrowing stops, fees drop, and financial stress starts disappearing. You stop being the perfect customer because you are no longer profitable to the system. $20,000 isn't wealth, it's stability. And stability changes everything. It changes how you spend, how you think, and how you negotiate. Financial freedom doesn't start with millions. It starts when urgency no longer controls your life. If you're serious about building wealth, ignore shortcuts. Focus on one goal. Build your first $20,000 savings buffer. That's where real stability begins. Because once you reach it, you stop surviving money and start controlling it. Enjoying the video? Hit like, subscribe, and turn on notifications for more money and success content.